I was broke the first time I tried to look rich, not poor on paper, not starving, but broke in the way that matters most. No leverage, no ownership, no real control over my future. I remember looking at successful entrepreneurs and thinking they had some secret formula, some hidden network, some magical advantage nobody talks about publicly. And then one day I realized something uncomfortable. Most millionaires are not smarter than everyone else. They just understand the game earlier. And once you understand the game, you stop chasing money the way everybody else does. That changed everything for me, because the truth is, my first million didn't come from luck. It didn't come from crypto hype. It didn't come from gambling on meme stocks. It didn't come from pretending to be rich online. It came from learning one brutal lesson. Cash flow matters more than appearances. That's the part social media usually skips. People love showing the Lamborghini. They don't show the debt behind it. They show the luxury office. They don't show the years of uncertainty, rejection, and risk that built it. Everybody wants the highlight reel. Almost nobody wants the process, but the process is where wealth is actually built. And if you're young right now, if you're ambitious, if you feel like everyone else is moving ahead faster than you, right? This story matters because the first million is not really about money. It's about becoming the kind of person capable of creating value at scale. That's the real shift. When I started, I didn't have investors lining up. I didn't have wealthy parents wiring me capital. I didn't have a massive audience. What I had was obsession, and obsession is underrated. I became obsessed with understanding how businesses actually make money. Not the motivational version, the real version: markets, distribution, sales, psychology, customer behavior, negotiation, branding, operational efficiency. I started studying companies the way athletes study film. Why did one business dominate while another disappeared? Why did some founders scale fast while others burn out? Why did consumers buy things they don't even need? Those questions became more valuable than almost any degree, because once you understand human behavior, business starts making sense. Think about it. Why does one coffee shop charge $3 while another charges $9? Brand perception, experience positioning, convenience. Emotion. People rarely buy products logically. They justify purchases logically after buying emotionally. That realization changed how I viewed entrepreneurship forever. And here's the crazy part. Most people wait to feel ready before starting something. That's a trap. Nobody feels ready. You think the first founder launching a startup feels calm? You think investors know exactly what will happen? Even billion-dollar companies make wrong decisions constantly. Business is uncertainty. The winners just learn to move while uncertain. That's the skill. I started small, really small. One of the biggest myths online is that you need some revolutionary idea to become wealthy. Usually you don't. You need execution. Execution beats ideas every single time. There are people with brilliant ideas sitting in apartments doing nothing. Meanwhile, someone with an average idea and relentless consistency builds a real company. That happens every day. My early projects weren't glamorous. Some failed immediately. Some barely made money. Some taught me lessons I didn't want to learn. Like this one: revenue means nothing if you don't understand profit. That lesson hit hard. You can have a business making huge sales numbers and still be losing money behind the scenes. That's why smart entrepreneurs obsess over unit economics. They want to know exactly how much it costs to acquire a customer, how much that customer spends, and how long they stay. Simple numbers, massive consequences. And honestly, most people ignore them because they sound boring, but boring fundamentals build serious wealth. The internet made entrepreneurship look flashy. Real business usually looks repetitive. Systems, emails, hiring, sales calls, testing, fixing problems, improving margins 1% at a time. Not exciting, but effective. At some point I stopped asking, how can I make money fast, and started asking, how can I build something valuable? That question changed my trajectory because value compounds. A good reputation compounds, skills compound, networks compound, capital compounds, even confidence compounds. But most people sabotage themselves because they want immediate validation. That's dangerous in business, especially now. We live in a world where everyone sees everybody else's success instantly. Someone buys a car, posts it online, and suddenly thousands of people feel behind in life. But you're comparing your reality to someone else's marketing. That's not intelligence. That's emotional manipulation. And if you fall for it, you start making terrible financial decisions. You buy liabilities, trying to look successful before becoming successful. That's backwards. Wealthy people often buy freedom first: freedom to choose projects, freedom to invest, freedom to say no, freedom to survive downturns. That's real wealth. I remember one moment clearly. I was sitting late at night reviewing expenses. Nothing glamorous, just numbers. Looking at where money was going, looking at inefficiencies, looking at opportunities. And I realized something powerful. Every dollar has a job. Rich people understand that instinctively. Poor spending habits aren't usually about intelligence. They're about emotional behavior. People spend to impress strangers. They spend to escape stress. They spend to feel successful temporarily, but investors think differently. They ask one question constantly: will this asset produce future value? That question alone can transform your financial life. Now, obviously, not every purchase needs financial return. Life matters too. Experiences matter, family matters, enjoyment matters. But if your lifestyle expands faster than your income, pressure eventually catches up, and pressure destroys decision-making. That's why so many businesses fail after early success. Founders increase lifestyle costs before stabilizing the business foundation. Then market conditions change, revenue drops, panic begins. You saw this happen repeatedly during economic downturns. Companies that looked unstoppable suddenly collapsed because cash flow disappeared. That's why liquidity matters. And this brings me to something young entrepreneurs underestimate constantly: survival. Survival is a competitive advantage. If you survive long enough while continuously improving, opportunities eventually appear. The market rewards persistence more than people realize, not blind persistence. Intelligent persistence, there's a difference. You don't keep repeating failed strategies endlessly. You adapt, you analyze, you evolve. But quitting too early is incredibly expensive, especially in entrepreneurship. Most businesses fail before they figure out product market fit. Not because the founders lacked potential, but because they ran out of patience, money, or emotional endurance. And emotional endurance matters more than people think. Building something from nothing is psychologically brutal sometimes. Nobody talks enough about the loneliness of entrepreneurship. The uncertainty, the second guessing. The moments where you wonder if everyone else was right. The pressure becomes intense because your results are public. And yet, that pressure can sharpen you if you learn to handle it correctly. I started realizing that entrepreneurship is basically emotional management disguised as business strategy. Can you stay rational when things go wrong? Can you think clearly under pressure? Can you avoid emotional spending? Can you ignore distractions long enough to build momentum? Those questions matter because momentum is everything. Once momentum starts building, opportunities multiply faster. People want to work with winners. Investors become more interested. Customers trust you more. Your confidence improves. But the early stage? Nobody sees that part. They only see success after it becomes visible. That's why comparison is dangerous. You might be 1 year away from a breakthrough while convincing yourself you're failing. And sometimes breakthroughs happen quietly, not dramatically. For me, one major turning point came when I stopped trading time directly for money. That's huge. Most people stay trapped there forever. You work 1 hour, you earn 1 hour of income. There's nothing wrong with honest work, but scalable wealth usually comes from ownership equity. Businesses, investments, intellectual property, systems that continue producing value without requiring constant physical presence. That realization changed how I approached everything. I began asking, can this scale? Because scale creates leverage. And leverage is one of the most powerful concepts in finance. Technology is leverage, Moody is leverage, code is leverage, teams are leverage. Capital is leverage. The internet created unprecedented leverage opportunities for ordinary people. That's one of the biggest economic shifts in modern history. A teenager with a laptop can build a global audience now. A small startup can compete internationally faster than ever before. Creators can monetize expertise directly. Software businesses can scale with relatively low marginal costs. These opportunities are real, but they still require discipline. That's the part people ignore. Everybody wants passive income. Few people want the years of active effort required to build it. And let me say something important here. There is no guaranteed path to becoming wealthy. Anyone promising guaranteed returns is either uninformed or selling you something. Markets involve risk. Businesses involve risk. Investing involves risk. That's reality. The goal is not eliminating risk completely. The goal is understanding it. Smart entrepreneurs don't avoid risk. They calculate it. Huge difference. There's also another misconception that slowed me down early. I thought making money would automatically solve insecurity. It doesn't. Money amplifies who you already are. If you lack discipline before wealth, more money can magnify bad habits. If you seek validation constantly, wealth often intensifies that behavior. That's why mindset matters. And no, I'm not talking about fake motivational slogans. I'm talking about behavioral psychology. Can you delay gratification? Can you think long-term? Can you avoid impulsive decisions? Can you focus deeply in a distracted world? Those abilities matter enormously, especially now. Attention has become one of the most valuable assets on earth. Companies are literally competing for your focus every second. Notifications, entertainment, algorithms, advertisings, everything is fighting for your attention. And if you can't control your attention, building anything meaningful becomes difficult. I started protecting my focus aggressively. Less noise, less comparison, less reacting. More learning, more building, more analyzing. And over time, patterns became clearer. One pattern stood out above all. The market rewards people who solve expensive problems. That's it. The bigger the problem you solve effectively, the more economic value you can potentially create. That doesn't mean every entrepreneur becomes rich. Of course not. Markets are competitive, but value creation remains central. Ask yourself this: why do certain software companies scale so rapidly? Because they reduce friction. Why do efficient logistics companies become valuable? Because they save time and money. Why do trusted brands dominate industries? Because trust itself has economic value. Trust is an asset. In fact, it may be one of the most underrated assets in business. If customers trust you, acquisition becomes easier. If investors trust you, capital becomes easier. If employees trust you, execution improves. Trust compounds just like money. And trust takes years to build but minutes to destroy. That's why reputation matters, especially online. Today, anyone can pretend to be successful temporarily. Renting luxury is easy. Buying followers is easy. Manufacturing appearances is easier than ever. But sustaining credibility over years? That's hard. And markets eventually expose fake value. Always. Which is why I became obsessed with fundamentals instead of appearances. What are the actual numbers? What's the retention rate? What's the profit margin? What's the customer acquisition strategy? Can this business survive economic pressure? Those questions matter more than hype. And hype is dangerous because it distorts judgment. You saw this during multiple speculative bubbles. People stop evaluating businesses rationally and start chasing emotional momentum. That happens in every generation. Sometimes it's real estate. Sometimes it's technology stocks. Sometimes it's crypto speculation. Sometimes it's startup mania. Innovation can absolutely create legitimate opportunities. But emotional investing without understanding risk can become destructive quickly. That's why financial education matters so much. Schools often teach people how to become employees, but rarely explain capital allocation, investing psychology, taxation basics, negotiation, or entrepreneurship. So people enter adulthood financially unprepared, then they learn through expensive mistakes. I definitely did. One early mistake was underestimating negotiation. Negotiation isn't manipulation, it's communication. Everything is negotiation: salaries, partnerships, contracts, equity, vendor pricing, advertising rates. And the best negotiators aren't usually the loudest people. They're the calmest. They understand leverage, they understand incentives, they understand timing. And timing matters in business more than most people realize. Sometimes the difference between success and failure is simply entering the market at the right moment. A mediocre company in a strong market can outperform a strong company in a collapsing market. That's reality. So I started paying attention to macro trends, consumer behavior, technology adoption, economic cycles, interest rates, market sentiment. Not because I could predict the future perfectly. Nobody can. But because understanding broader conditions improves decision-making. For example, when capital is cheap, startups often grow aggressively. When interest rates rise, investors become more cautious. Suddenly, profitability matters more than growth at all costs. Different environments reward different strategies. Smart founders adapt. That adaptability became critical in my journey, because every stage of business requires a different version of you. In the beginning, you do everything: sales, marketing, customer support, operations, maybe even packaging products yourself. Then eventually, if growth happens, a new challenge appears: delegation. And delegation is difficult for ambitious people. You think nobody can execute as well as you can. Sometimes you're right, but scaling alone eventually becomes impossible, so you learn systems, processes, hiring, leadership. And leadership is another thing people misunderstand completely. Leadership isn't dominance. It's clarity. Can people understand the mission? Can they trust your decision-making? Can you create accountability without destroying morale? Culture matters because culture shapes execution. Weak cultures create chaos. Strong cultures create alignment. And alignment creates speed. That's one reason some startups move incredibly fast while large corporations struggle. Smaller teams can adapt rapidly, but speed without direction becomes dangerous too. I learned that focus creates disproportionate results. One excellent business can outperform 10 mediocre projects, yet ambitious people constantly get distracted by new opportunities. I did too. A new trend appears. A new platform appears. A new investment appears. Suddenly attention splits everywhere. That's expensive. Because scattered energy weakens execution, and execution remains the ultimate advantage. Even in investing, people think investing is about predicting the future perfectly. It's usually more about discipline. Can you avoid panic during volatility? Can you think long-term? Can you diversify appropriately? Can you admit mistakes quickly? These behaviors matter more than flashy predictions, and diversification matters for a reason. No investment is guaranteed. Even strong companies face competition, regulation changes, technological disruption, or market downturns. That's why risk management exists. One of the biggest mindset changes for me was understanding that wealth preservation eventually becomes as important as wealth creation. Completely different game. At first, you focus on growth. Later, you focus on sustainability. Taxes matter more, asset allocation matters more, liquidity matters more, downside protection matters more, because losing money psychologically hurts more than making money feels good. Behavioral economists have studied this repeatedly. Humans are emotional investors. That's why market bubbles happen. That's why panic selling happens. That's why financial discipline is rare. And rare behaviors often create disproportionate outcomes. Reading became one of the highest return investments of my life. Not because books magically create success, but because they compress decades of experience into days of learning. Biographies especially changed how I viewed entrepreneurship. You realize legendary founders were uncertain too. They failed too, they adapted too. Nobody has a perfect path, and that realization becomes liberating because perfectionism kills execution. Some people spend years planning businesses they never launch. Others start imperfectly, learn quickly, and improve through experience. Action creates clarity. Not the other way around. I also learned something uncomfortable about success. Some people around you will become supportive only after results appear. That's reality. When you're unknown, your vision sounds unrealistic. When you succeed, the same vision suddenly sounds obvious. You can't build based on external validation. If you do, emotional inconsistency destroys momentum. That's why internal conviction matters, not arrogance. Conviction, there's a difference. Arrogance ignores feedback. Conviction processes feedback without abandoning the mission unnecessarily. And feedback matters because markets are brutally honest. Customers don't care about your excuses. If the product is weak, the market responds accordingly. That can feel painful initially, but it's useful. The market gives constant information. Gossamer behavior reveals truth faster than opinions usually do. That's why data matters, not vanity metrics. Retention, conversion, cash flow efficiency, lifetime value, these numbers tell stories. And stories inside businesses determine outcomes. Over time, I became less emotional about money itself and more fascinated by systems. How does capital flow? How do companies scale? Why do monopolies form? Why do certain industries produce enormous margins while others remain brutally competitive? Understanding systems changes how you operate financially. You stop reacting emotionally to headlines constantly. You start thinking probabilistically. You accept uncertainty instead of fearing it. That's important because certainty in markets is often an illusion. Nobody knows exactly what happens next. Not investors, not economists, not CEOs. The goal is building resilience. And resilience isn't just financial. It's psychological. Can you continue operating effectively during uncertainty? That skill alone creates huge separation, especially during downturns. Economic downturns reveal everything. Weak businesses get exposed. Over-leveraged individuals struggle. Speculative excess collapses. But disciplined operators often find opportunities during chaos. History shows this repeatedly. Some of the strongest companies were built during difficult economic periods because constraints forced efficiency and innovation. Constraints can sharpen creativity. When resources are unlimited, people become careless. When resources are limited, prioritization improves. And prioritization is one of the most valuable entrepreneurial skills. What truly matters? What actually drives growth? What activities produce real outcomes? Most people stay busy, few people stay effective. Big difference. At one point, I realized my first million wasn't created in one dramatic moment. It was accumulated through repeated intelligent decisions. Smaller wins stacking together. A good investment here, a successful project there, a disciplined expense decision, a valuable partnership, a strategic risk. Compounding quietly worked in the background, and compounding is almost magical over long periods. Not just financially, skill compounding matters too. Public speaking compounds, sales skills compound, writing skills compound, notation compounds, reputation compounds. That's why consistency beats intensity over time. People dramatically overestimate what they can achieve in 1 month and underestimate what they can achieve in 10 years. That principle changed how I think about ambition. You don't need to become wealthy overnight. You need to keep increasing value steadily while avoiding catastrophic mistakes. That's more sustainable. And honestly, healthier, because burnout destroys potential constantly, especially among founders. The hustle culture online sometimes glorifies exhaustion like it's a badge of honor. That's dangerous. Sustained performance matters more than temporary overwork. You need energy to think clearly. You need health to sustain ambition. You need perspective to avoid self-destruction. Money without stability often creates chaos. And eventually I understood something deeper. The first million matters emotionally far more than practically. Why? Because it changes your self-image, it proves scalability. It proves leverage works. It proves disciplined execution can create substantial outcomes. But after that, the real game changes again. Now it becomes about impact, freedom, legacy, creating things that outlast temporary trends. And honestly, that's where entrepreneurship becomes more meaningful, because eventually material goals lose emotional intensity. Human beings adapt surprisingly fast. What once seemed impossible becomes normal. That's why purpose matters. If money is your only motivation, business becomes emotionally empty eventually. But if you genuinely enjoy solving problems, building systems, creating value, helping customers, investing intelligently, the process itself becomes rewarding. That mindset sustains long-term success better. And no, this doesn't mean every entrepreneur becomes endlessly happy. Business remains stressful. Markets remain competitive. Mistakes remain inevitable. But perspective changes. You stop chasing status and start chasing quality. Quality businesses, quality relationships. Quality decisions, quality time, that's real wealth. And one final thing, the internet loves extremes. Either become a billionaire instantly or wealth is impossible. Reality is more nuanced. Most financially successful people built gradually. They learned continuously, they adapted repeatedly, they failed sometimes, they improved consistently. That's the pattern, not overnight miracles, not secret formulas, not guaranteed outcomes. Just disciplined execution combined with intelligent decision-making over long periods of time. That's less glamorous, but it's far more real. So if you're watching this right now wondering whether you're behind, you're probably earlier in the process than you think. Learn skills, protect your attention, study businesses, understand psychology, think long-term, build credibility, take calculated risks, avoid emotional financial decisions, and most importantly, keep building. Because the distance between where you are and where you want to be is often shorter than it appears when you commit fully. My first million didn't change everything overnight, but the process of earning it changed me permanently. That was the real return on investment. And maybe that's the lesson most people miss. Money is important, but the mindset, discipline, resilience, and perspective you develop while building wealth. That's the part nobody can take away from you. If you enjoyed this video, subscribe for more deep dives into entrepreneurship, investing psychology, business strategy, and the realities behind building wealth in the modern economy. Because in a world full of noise, hype, and distractions, real financial education has never been more valuable.